Hey, welcome to another episode of Regenerative Inspiration. This is a place where we are finding encouragement, hope, inspiration for leaders, aspiring leaders. It really touches everybody. We always talk about innovation. We always have great guests on that talk about a variety of topics. We also have a touch of adversity and how our guests have overcome that, how they've seen people overcome it, bringing you that hope in a world that's not always friendly, right? And so that's Regenerative Inspiration. Make sure if you like this episode to share it, like it, follow it. And I've got a great guest today. He's absolutely fantastic. We've just known each other a very short time, but Dominick, I can't really pronounce your name very well, so I'm going to have you do that. But Dominick's been a professor at DU and CU. He's been in the derivatives market in the financial sector for many, many years, lived all over the US and has, a ton of clients and a lot of great inspiration as well as information that people need to know, because a lot of times when you're going through adversity, 8 times out of 10, there's a financial aspect that makes it worse, right? So they say money doesn't solve all problems, but you know what? It's really nice to have it when you're going through problems. So understanding how money works, how it's, created, as well as how you can leverage it as a individual, as a family, as a business, is incredibly crucial in today's day and age, especially now. There's a lot of volatility, a lot of hyperinflation at the moment. But Dominick, give me a little bit more of a just intro, and Dominick, say your last name for me one more time.
Paoloni.
Okay, so now you see why I had a little problem. You got to have the Paoloni.
Yeah, well, I was named after Domenico Paoloni, but the American pronunciation is Dominick with a K. So
perfect. Well, tell me a little bit about your story, where you came from.
Born in the Bronx, born and raised in the Bronx. Went to Boulder. That's how I discovered this part of the world. When I graduated, moved back to New York, worked on Wall Street for 10 years, a decade, and realized that I could do this on my own. So I started my own firm in Miami, fell in love. She was from Arvada. She wanted to get back home. So that's why I got back here. And Colorado's, I love Denver. It's gotten way bigger than I would like, but it has an area place. So, and that's it. I've been in this business over 30, 35 years. I've seen every aspect of the financial. And unfortunately, I've seen good and bad. And when I was on Wall Street, I saw mostly bad. It's just all about greed, and it's pushing product. It's not about getting people rich and wealthy. I'm not saying there are people out there do a good job, but so I learned a lot. Knowledge is learning, wisdom is doing. I have a lot of bright young people, but you can't teach wisdom. I wish I could. You got to do it, right? And so,
yeah. Yeah, that's a key point. Well, tell me a little bit about what, we were talking off camera just on some of the things that you're doing with derivatives, hedging, different things. Talk about how that flips the traditional side on its head a little bit.
And thanks, Bill. I've been doing this long enough to understand that my passion as an academic and as a practitioner was really to try to model and to really do the best for my clients, to grow their money so they could retire. But unfortunately, I found out that the dogmas of our society are about a diversification, just diversify. And it's the herd mentality. And I realized there was times when it didn't work. The dot-com bubble, the 2000 credit crisis. The dot-com bubble, the 08, 07, 09 credit crisis. 2022, look what happened in 2022. Everything crashed. The problem with diversification, it works when you don't need it. When you have a real market crash, everything crashes. The long bond was down almost 30% in 22, and the NASDAQ was down 30%. So where's diversification? So you look at a diversified portfolio, noticeable everything was up today and everything was down today. It's like driving a car and hoping your brakes work. That's scary. It's like, I got to stop. I hope my brakes work. That's how I am going to recommend to a client to build their future. So as I started to learn that, I said, is there a better way? And I started to look at derivatives. One of the biggest users of derivatives, believe it or not, is Warren Buffett. And I thought, oh my God, what is he doing? How is he doing it? How can I use this tool to really define risk tomorrow, today? Now think about what I just said. I want to know my risk tomorrow, today. I don't want to hope that my diversified portfolio works. So I really dug into how to use derivatives in a model framework. And here's what happened. What happened was when I started to flip that switch from a diversified portfolio within my asset management base, my client base, to derivatives, my business really slowed down. My referrals stopped coming. A number of people fired me because they said, wait a minute, you're going to use options within my retirement portfolio? Options are risky. The sad thing is exactly the opposite. Used correctly, they're a tool that, if I can give you the market upside and cut off your downside tail, it's like, well, why wouldn't everybody do that?
Yeah.
Well, most people...
Well, why wouldn't they do that?
Well, two reasons. I believe that the industry is driven by the banks that build product. Those products have fees, whether it's annuities, whether it's private equity, whether it's even mutual funds. They're charging expense ratios. So they want their advisors to push. I don't want to beat up on any big banks, but you go to Merrill Lynch, you're going to own all Merrill Lynch products. You go to JP Morgan, you can own mostly JP Morgan products. Now, I'm not saying you've got these ETFs and they're low fees, and I'm not saying they're pretty much trend following, but they're also market one, they're delta one. What that means, the market goes up 10, you go 10. Market goes down 10, you go down 10. Well, that's great, but then you have a crisis like 2000 where the market drops 3 years in a row. And at the end of that bear market, you're down 67%. And then the market starts to climb to 07. And then the market drops to 09. So you've got almost 10 years before you made no money. And that's not even counting for inflation. So what if I could just cut off that tail with the proper use of derivatives? But unfortunately, it's complicated. The banks don't want the advisors to because there's no commission, there's no comp. Client asked me the other day, what do you think about private equity? I said to her, let me ask you a question. If I sold you a private equity product, I would get 10 to 15% comp on that. Think about that. You give me $1 million, I'm going to make $100,000 commission. I trade a derivative, it's $1.75. So why do you like private equity? You like private equity because it's being pushed, it's being sold like annuities. If I tell a client walks in and says, yeah, my Wells Fargo guy just put me in an annuity, I said, fire him. Because I believe that an annuity is a compensation scam. I'm not saying it's a scam. They're going to pay an agent 10% commission to sell you an annuity. That's an inferior product. Client comes to you, a quick story. Client comes to me, 72 years old. He says, Dom, I just was at a dinner at Del Frisco's and all the wine I could drink, and I just put $400,000 into this annuity. I'm telling you got to get your clients in it. I said, John, let's do this. You bring in the policy. Let's get customer service on the phone. Let's see what you got. I get the lady on the phone. I start asking her questions. Turns out his annuity, he ties his money up for 20 years, and his annualized return after everything through accumulation and distribution is going to be about 1.5% over 20 years, and he's 75 years old.
Wow.
I said, John, I like to get kissed before I get, fucked. I said, you didn't even get kissed. So unfortunately, what drives that industry is comp. And that shouldn't be the way, but that's...
Yeah. So there's going to be people right now that it's going to be glazing right over. Share a very simple example to those that might have already been lost by what you said so far. And then we're going to go deeper.
Okay, a simple example on the use of derivatives, simple example on just how to manage risk properly.
Yes, that. Like, how do you manage that risk when you have your traditional market here and then you're hedging against here? Just let's get an example on that, and then maybe we can work into some of the more things.
Yeah, well, as I said, diversification model means if I just buy more stuff, I'll be safer and safer and safer. And that's really good for the marketplace. That's good for the big banks that create products, because if I just buy more of whatever, of your fund or your ETF. My argument is I'll be long the S&P, so I'll be 100% exposed to the S&P, which means, that's if you're 70 years old and an advisor said, here, put your $1 million in the S&P 500, you would say, yeah, but the S&P 500 has years where the market could drop 30%. And as a retiree, you can't afford that.
But they don't say it that way. They say over the last 30 years, it's done this.
Right? That's correct. But the problem is, Albert Einstein said the greatest invention of mankind is compound interest. Money grows exponentially. Mm-hmm. And I would say to Dr. Einstein, but Dr. Einstein, that means the worst invention of mankind is negative compound interest, because money loses exponentially. If you lose half your money, you got to make 100% to get back to break even. You lose 60% of your money, you got to make 175% to get back to break even. So now, as Warren Buffett said, the secret to investing is you don't have to win. You can actually make less as long as you can hedge the downside. That's why Warren Buffett, he just retired, and that's why he's a trillionaire, because he says, don't try to get rich quick, get rich slowly. And I'm not saying that. I'll give you a good example. If I take the S&P over the last 20 years, and I give you and I put your money in the S&P over the last 20 years, and say, okay, what's my return? And then I said, what if I can give you 75% of the S&P? So if the S&P is up 10, I'm up 7.5, but cut off your downside. So the down years when the S&P in 22 was down 25, you'd be flat.
You didn't lose anything.
You know what? I would blow you away over that 20-year period.
That's
my return would kick the long position. So what does that mean? I don't need to win. I'll use that. I'll be willing to take a little bit less on the upside to get rid of that downside risk. And that's all. That's a derivative is a type of an insurance policy. The only thing that I do well is figure out how I can use a derivative and pay zero to very little. I don't have to pay the exorbitant cost of that insurance. It's about, I own a home in the mountains right now, and I got quoted because I'm surrounded by trees. I got quoted $30,000 a year in homeowners insurance. I just about had a cow because they said, well, for you to insure your home with all your trees around your property, we're going to charge you $30,000 a year. Same thing with market insurance, puts, okay, using puts and calls. As a raw product, they're too expensive and they're complicated. But as an academic who's taught it for many, many years, I could learn how to use that and reinsure that risk. So maybe it's costing me 1% or 2% to insure that downside tail, and say, okay, Mr. Klein, are you willing to get only 75% of the upside, but if in a down year, you would lose nothing. So all it is just insurance. It's what I call the Warren Buffett principle, put on steroids, if you will. If that helps.
But I love the fact that you're mitigating your risk, right? So, and that's what the derivative does.
And that's what it does.
To ultimately balance that out. Yeah.
But it's not, it's the Merrill Lynch's, the JP Morgans, the private wealth banks. I get clients come in, they go, I'm a private wealth at JP Morgan. I'm thinking, okay, they're in more advanced strategy. No, just, they're long Vanguard ETF or long a mutual fund, American Growth Fund. It's like, this is something that, a pie chart you can click on with AI and you could build in 2 seconds. So why do you you don't need a financial advisor, because most of them are just selling you stuff that is probably not in your best interest.
Yeah. Yeah. Well, it's got to be simple enough for them to be able to sell. They don't have to be the expert necessarily, but they're taking that product that they have to sell from their employer as well, which is a problem.
And they're helping you shop. They're not building. We build products. We build custom products at our firm. Right. So you can't buy our products on the street. We custom build them. So they're just helping you shop and charging you 1%, 2%. And then if they're selling you a product with a huge comp, they're making that on top of it. But unfortunately, that's what's happening throughout the world.
So with what I'm hearing right now, though, the investment strategy could be the same for a 70-year-old as it could be for a 20-year-old.
Exactly. Because in the long run, if you're a 20-year-old and I could win by not losing, because people say to me, Dom, you're too conservative. One of my younger clients, mid-40s, he called me up recently. He goes, Dom, you're too conservative. And I said, well, your portfolio is performing exactly as it was designed. The S&P is up 20, you're up 15. I said, so where's the surprise? He said, well, I'm 45. I'm in the Mag 7. I'm in the NASDAQ. And I said to him, yeah, but how much did you lose in 22? Lost half his portfolio in 22. Yes, did it come back? Yes, it did. But what if you were flat in 22? You don't need to win in 2023 or 24.
Right.
But yes, that's exactly right. If I can cut off my tail, I don't need to win. And that's the secret.
You touched on a really interesting point. Most people can't do math in the first place. So if you lose 10%, if you gain 10% back, you're not at even.
That's right.
Do the math. I think anybody that's at home should do the math. Like, I've done this with my kids. I'm like, okay, you lose 10%. How much does it take to get back? It's like 12 and a half, right?
That's right.
Or something, 15, you got to get more. It's like, so, if you lose, like you said, 50%, you need to have 100% return on what's remaining to get back.
Just to break even. And not accounting for the depreciation of our asset called inflation, which the government lies about, by the way. Inflation is not 2.9%.
Right. Look at the gallon of milk, right? Look at the eggs. Look at that. Yeah.
Do you know, okay, here's an interesting fact. Do you know they continue to change the formula for the inflation data? If you use the data that they used in 1980 to calculate inflation, the CPI, the inflation number, would print at 12% today. That's a fact. Shadowstats.com. I'm not lying to you.
Wow. Shadowstats.
Shadowstats.com.
Shallow or shadow?
Shadow, like a shadow?
Yeah, shadow.
Shadowstats.com, yes. And then they changed it again in 90, 92 under Clinton. And if you use that formula, inflation would be 8%. Yeah. But they're telling us now inflation is 2.9. I shop, you shop.
Yeah.
Hello.
Yeah.
So a dollar pays, a client comes to my office and she says, Dom, I don't need to invest. I'll just keep the money in the money market because it's paying me $2,000 a month on my retirement money. I said, here's the problem. In 10 years, you're going to be homeless because your $2,000 a month, what it buys today, is going to buy a fraction of what it buys in 10 years.
Right.
And so good luck with that. You need to be invested. People say, well, I'm in a market time. Good luck to you.
Yeah.
Good. Hey, you're better if you have a good astrologist or you're good with the cards, but I'm not.
Let's dig into that more because a lot of the housing market, obviously, we know is because of hyperinflation. We talked about silver and gold off camera too. I want you to talk about what, some of those standards, you talk about the gold standard. You talk about, what these assets have been, right? And even commodities. Like what does it look like in the commodity market? I'm in Texas, cattle, boom. It's way up here. I mean, we're looking at like a significant amount. Like a calf used to be 1,100. Now it's like 4,000. I mean, it's significant.
And that's good
difference. It's not because the problem is there's costs across the whole board.
Right.
So it's not like that's all profit
corn,
because it costs more to get back in. Like, I mean, there's a lot of things. I mean, you have to balance. Farming is, I think there was a great, quote one time, and a guy had won the lottery, and he said, what are you gonna do with all the money? He's like, well, I'm gonna just farm until it's all gone.
There you go.
But farming is essential, and I love farming, regenerative farming especially.
Yeah.
And I look at things differently because I want things to be an ecosystem. And it sounds like the way that you look at financial is the same way, because if you can get everything working as an ecosystem, in the soil, you got to have the microbes working to hold the water. They're disease resistant. But if you come and just throw chemical on it, like it's going to kill everything. And then that plant is on its own. Now you could keep throwing chemical fertilizers, everything else to keep it up. And if you built the ecosystem in the right way, the soil is the most powerful thing you could have because you could grow anything in great soil, right?
Yeah.
So if you create the right soil in the financial.
Yes. And Will, I'm not saying that because I do build a diversified portfolio. I do have money in China. I do have money in Europe. I do have money in gold. I do have money in S&P, but I hedge every position.
Yeah.
So I'm not, because, China's up 28%, Europe's up, 25. The S&P is underperforming those global markets. Gold is up over 50%. I want to own those, but why not hedge that as I own that diversified portfolio?
Yeah.
So you're right. It works like an ecosystem. The benefit of diversification is there's assets that'll do better than other assets in different years.
Right.
But I don't want to be in the S&P when it's down 30% and say, well, shucks. And not only that, then think about China. China lost 50% when they shut their whole economy down for a year over COVID.
Right.
Oh my God, people that are investing with China just got pummeled. But then China's exploded. It's the second largest economy in the world, probably going to be the largest. I want to own assets there, but I don't want the volatility. I don't want the downside.
Yeah.
So that's a good point.
Well, let's talk about silver and gold. It's because silver's, I think it's at 63 today. Gold is, crazy. So talk about that a little.
Commodities are on a super cycle. I teach a class at CU, a master's class called commodity hedging. And you're right. The problem is, as a farmer, you're raising cattle, but then you have to buy the wheat, the corn, which has gone up in price. So your margins are not where they need to be. So the idea, and it's kind of interesting, the commodity industry, a good part of it does understand hedging. They want to take a variable cost. An airline says, okay, Southwest says, listen, our profits are going to be determined by supply and demand, how many people are flying, but also our jet fuel costs. Can I take that from a variable cost to a fixed cost? Can I get that off? I know what my price is going to be tomorrow, today. It's exactly the same thing I do with equities. They do with commodities. Could I normalize that cost? So we do the same thing with commodities. We hedge, we build hedge products. But what's happening with the metals, what's happening with oil, I think copper is the great story right now. Most people don't know that the AI boom uses massive amounts of copper, massive amounts. And the demand is so much outstripping the supply that's out there. It's got to go in one direction. And you can buy copper through some really good ETFs and hedge it off. Gold, another one. When Trump became president, his policy was to weaken the dollar. And gold is priced in dollars. So it's a relative value. If what is priced in is losing value, then this has to go up. Plus, Trump has a way of pissing off the global world. And so what a lot of global economies have done is taken their money out of treasuries and moved it into hard assets, gold. Central banks around the world are piling into gold. So gold's another great asset. Silver, because it has a dual purpose. It's a monetary value plus what is being used in the IA explosion. So how could you not own these assets? And they should be in your portfolio. Absolutely. Absolutely.
So I know there was a conversation years ago I had heard, and it was, Corvette in 1969 was the same amount of ounces of gold as it is today. And I haven't done the math on that lately, but it seems like it might actually work. If gold was maybe $200 or something back then, we had so many ounces and it was $2,500 for a Corvette. Now it's
isn't that interesting?
120,000 or 150,000 for a Corvette, but you take the same amount of ounces, it would still equate, right?
Exactly. And that's a great point, Will, because that's the argument against being in cash. Well, I don't want risk. I want to be in cash. You can't. You're losing. If you believe in the real rate of inflation, and you're losing 8 or 10% a year. Mm-hmm. So if you're making 10% or 12% on gold, at least you're keeping up with even the cost. And that's why you have to be invested. Do you realize that gold started its super cycle in 9/11?
No kidding.
Gold was $400 an ounce in 9/11, and it slowly has been rising. And then, of course, it's exploded under Trump because, like I said before, but...
Well, what do you think? I don't normally get into too many politics or current events but the financials are always current. So if you have hyperinflation, you could pay off the debt potentially faster if the dollar's weaker. Is that possible? Can you pay debt with debt?
Weakening the dollar is going to make the payoff. But the problem is, here's the problem. If you look at the global economy, the dollar is the best looking horse in the glue factory. Okay. Yeah. With massive deficit spending. So if we move into a situation where we don't become the global reserve currency, and think about this, that Saudi prince that has $1 trillion, that the oligarchs of Russia or, whatever, where are they going to put their money? They're not going to put it in the renminbi. They're not, because it's a totalitarian state. They're not going to put it in the ruble. They're not going to put it in Russia. The euro's got its problems because they're always fighting. It's a loose union. The yen, actually, believe it or not, Japan, their deficits are twice as high as ours. Right. They're 200 times debt to GDP. So where does serious money flow? It flows into dollars. So the backlash of what you're saying, and you're right about that, is if we lose our reserve currency status, that means that to get people to buy our treasuries so we can finance our deficits, we're going to have to raise interest rates and say, people, I'm not going to take risk at 3 or 4%. You pay me 8 and I'll buy your treasuries. What happens to interest rates? And it'll crush our economy, as we know. So there's a double-edged sword there. And that's the problem is, if our trade deficits drop because of a weak dollar, well, that means companies that are buying goods become more expensive, right, on a relative value basis. Yeah. So I think the Trump administration is making a mistake. I think most economists would agree that his tariff policies historically are not good. His advisors around him are advising him. And so that's why I said, listen, if I wasn't doing what I did for a living, which is hedge, I wouldn't be able to sleep. And I don't know that I have my clients invested where I have them, but at least I can sleep and I know, okay, I've got a parachute behind your portfolio.
Yeah.
And that's how I'm able to sleep at night.
Yeah. I think that's awesome. So we always talk about adversity, and you touched on it just briefly earlier, but can you touch on a little bit of what that goes through? Because I'd mentioned, finances are a lot of times the adversity that people have to overcome, right? And especially in today's day and age, as a business owner, costs keep going up, clients don't want to pay you more because it's going up for them too.
That's right.
So there's always this balance of like, how do you give them more value for their dollar and then still make a profit because you have to, and then keep everything working the way it's supposed to. So talk about like the time where you exited, started your own firm, started telling people the truth about what you really believed. Tell me about that a little bit.
A lot of my friends who are just, I don't use the word salesman, but don't have a lot of depth knowledge or not so much of an academic point of view from the financial world, their assets under management have grown exponentially, as mine did until I flipped to using hedging within my framework. And my referrals stopped, not because my clients didn't like what I did, but they didn't say, yeah, my advisor uses options to manage my risk. I'll tell you a quick little parable. I decided to grow my business. I said, let's just start communicating with our clients' kids, because most of my clients are 70, 80 years old. It's serious money, and they have kids our age. Well, the bottom line is, I remember my client, 10, 15-year client, she goes, Dom, I love what you do. I love your growth. But my son is beating me up and saying that you're invested my money in options and I can't sleep at night now. So I feel really bad, but I'm going to have to fire you. That's a true story. So I had to make a decision, do the wrong thing and be managing hundreds of millions of dollars. I manage hundreds of millions, but not where I should be, like a lot of my friends are just asset allocators, to what I thought was the right thing, and not pushing things like annuities and high comp and private equity with high comp, but putting people in what I believe is best for them and not being as successful as I like to be. And it's frustrating. It's frustrating every day, because when you start talking about what I do, people glaze over and they go, I don't know what you're talking about. 99% of my clients say, Dom, I don't know what you do, but I trust you. That's great, but that's not going to help me try to make people understand that the dogma of diversification alone is being sold as a herd mentality, and there's better ways to manage risk than 99% of the streets doing it. So I'm fighting that tide, and I guess, at one time when who was it that said the world is round, and they thought he was a heretic, Galileo, whatever, and everybody thought the world was flat. Now people think the world's flat again. I don't understand that one.
It is an interesting one. We haven't talked about that on the podcast yet.
Okay.
So yeah, and I think you just keep hitting the nail on the head, and I think the balance there is that people want to do what everybody else is doing, and then everybody's gonna get hit by the same thing, and it makes complete sense to me how you're hedging. It makes complete sense, and so I mean, from a standpoint of everybody has to take their own financial advice and stuff. I'm not giving that right now, but you could I guess, but it's like a matter of what is their tolerance to trust, right? And like then seeing how that money can work over time, because it is a recipe. I mean, it's a recipe that works.
It's a formula.
Yeah,
it's a formula. It's complicated, yes. People say, can't you dumb it down? Tom, can't you make it simple? Well, how about I can give you the upside? I can give you 75% of the upside and cut off your downside. How would you like to do that?
Yeah.
Okay, that's pretty simple. Now, how do you do that?
Oh,
so you want me to get under the hood, do you? You want me to? Yeah, I'll do that too.
Yeah.
But I don't invest in what you don't understand. Wait a minute. So if you have heart surgery, you don't do it because.
Yeah. Let's talk a little bit more on the sophisticated side of things. So you were talking about some quantum different things. I want to jump in that a little bit more. Can you tell me a little bit more about what you're teaching your class now, how things are moving in the future? You could talk about blockchain a little bit as well. I mean, we talk about that pretty often too. I mean, anything innovative that's happening that I think people should be aware of.
Well, it's interesting. The largest hedge fund in the world is Citadel, and they manage their own money. They don't manage outside money. And isn't that interesting? The quantitative industry is exploding, and the universities are embracing it, not DU. I used to teach at DU. I still teach at CU, because DU decided to move derivatives off their platform as a required curriculum. And because they got the new dean came in and said, no, that's for a Chicago booth. That's for NYU Stearns. That's for MIT. But don't you want DU to be a top tier school? So I was very frustrated by that. I argued with the dean several times. I couldn't get him to move on that. And that's a shame because I think the young kids do want to be innovative. And what I do teach, and I have a big intern program, and these kids work for free. I mean, these kids, I don't pay them, but I teach them. And it's not I'm exploiting them. They're saying, I want to learn what you know, and I'm willing to work for you to learn that. And I respect these. It's like, wow. And I got to tell you, my whole firm is ex-interns because I know what I have. I know these kids have passion and they're beautiful. So it's just, let me show you a better way to do it. Let's get a move from the herd mentality, the group think, which drives humans, right?
Yeah.
How did they follow Hitler?
Yeah.
So.
Yeah, it's interesting. What else? What else are we missing?
As far as what? As far as
innovation in the space. I mean, money is money. I mean, money has had the same principles. I mean, you can go back to Richest Man in Babylon, a great book that my dad always said, hey, read this every year. And it's like there's principles of money and gold that have worked since, Babylonian times, but it's like there's always a little bit new ways of working with that, especially with inflation, especially with different
places. Well, my attitude is this, that like I own real estate holdings as you do. I have different types of equity. I have speculative. I have more core assets. I was talking to a friend today, younger man. He wants to fly out in the summer and intern with me. And he's like, oh, I'm in NVIDIA and I'm in Amazon. What do you think, Tom? I said, yeah, I like NVIDIA. I like Google. But I also think that, like we said, the hard commodities are a good thing to do. So I think as from a financial point of view, be diversified, but can you in ways just think about risk in a more macro way. We tend to think linear. And so I think if, we're old enough to remember life doesn't do this, it kind of goes in a sine wave. I remember when I was working on Wall Street and I was making boatloads of money, I thought, oh my God, I'm going to retire at 30. Well, that didn't happen because, you do this, right?
That's right. Yeah.
So I guess the innovation is, and I think the reason why you see a Citadel that's doing its own money is what are they doing? How are they running money? What techniques are they using? And you're always going to come down to very different than what's going on in the financial community. So unfortunately, just because everybody's doing it doesn't mean it's the right thing, but that's how we as humans or I guess globally think. And I think it's when you're outside the box, you can be attacked. And if you're slightly wrong, they'll be buried. But that's where genius comes from. What did Albert Einstein say? True genius is applying imagination to knowledge. So if you've got an idea and you can spin it and put it into your right brain, I think that's where the magic happens. And that's what I try to do with what I do for a living. And so is there any other magic? There's a lot of exciting things happening. And I think if you put your ear to the ground, Will, like I said, silver, gold, oil. I think commodities are a great space. I think they're a great space. And I want to own those, and my clients do own those. But I also understand, as you said, that you can't put an 80-year-old in long silver or long gold or long copper unless you think about, okay, what type of volatility does that asset hold? Even crypto. I mean, Bitcoin, I can invest in Bitcoin and hedge it. So I could be long Bitcoin, but if it comes back on me, at least I'm cutting off most or not all of the tail. So what a great way to grow your money. Yeah. I don't have that with real estate quite because real estate's a little bit different, and I know you own real estate. And so, how do you hedge your real estate? Well, you could hedge it through the capital markets, but if you own real estate, I don't know. I know Denver's gotten hurt a bit. We've seen prices come down in Denver quite a bit.
Right.
But I think it's just a cycle. It's a supply and demand cycle because the bottom line is people are moving here like in droves. Right. So I don't think you're going to get hurt. You might have to sit on a little bit. Hopefully you're not getting killed by interest rates. I did figure out a way to get cheap money, which is good. Recently, and I think that's really exciting. But yeah, when you're holding an 8%, 9% mortgage, that can get tough.
Yeah, well, I mean, that's where, the arms and stuff in 2006, 7, 8, like that's where everything got screwed, right?
And a lot of people got screwed.
They just walked out, you know, I mean, they just
Yeah.
walked out of the house, you know, so, and I don't see that this time. So at least there's been some guards put in. So tell me about what you would tell your 22-year-old self on strategy at this point, because we talked about GameStop a little bit, you know, and I think there's a lot of young kids, whether they're going after meme coins, whether they're going after the GameStops, whether they're going after different things, they might have a success, but that doesn't happen every time.
Right.
So what advice would you give to yourself?
Well, Robinhood has kind of changed the game.
Yes.
I mean, and everybody's now, and derivatives are becoming very popular among young kids because of Robinhood. So it's funny because a lot of these, you know, people are calling me about these strategies that I've known for 20 years. And I say, well, I'll repackage it. I'll cover call writing on steroids. Well, the devil's in the details. And unfortunately, a lot of the young kids think that because something's working today, it will work tomorrow. If I've learned anything in my practice and in the financial markets over 30 years, something might work for 2-3 years and then it doesn't work. And then you give it all back. And that's one thing I've learned and I've continued to learn. The average, you realize that buy the dip is a prevalent strategy today. If you bought the dip in 2000 and kept buying the dip in 2000, you would have been financially destroyed by the end of that down cycle. By October of 2003, you'd have been done. October of 2002, you'd have been done. And then they said, well, but if you'd held on, but there's a pain point. There's a point when you say, hey, I can't, especially if you're retired, I can't afford, I will be homeless if I lose any more. And that's called capitulation. And so that means when people are all done selling, that's probably a bottom because there's nobody left to sell. Yeah. And Warren Buffett said it, says, when there's blood on the street, that's when I'm buying.
Yeah.
And so that's the problem. The problem is you got to, yes, over the long term, but even over the long term, I don't want to lose 10 years of compounded growth because the market decided to take a shit in 2000 and 2008. So what if I didn't have to do that? What if I could have held in those down years and made a little bit less in those up years? So like you said, you're getting back to the negative compounding of money. So is there a new fix? The new fix is young people don't understand that. They just think, I'm alive 25 years, and since I've looked at investments over the last 2-3 years, this is working, this is a magic bullet. Well, now with AI, everybody's coming out with a scheme. And everybody, even smart people, are getting thrown into these schemes because AI is the magic bullet to invest. And it's not. It's just a group think. They take all the internet stuff, they throw it into a funnel, and they go, here's your answer. But the stuff on the internet's not always accurate. We know that.
Yeah.
So be careful. Be careful. And I just did a short thing on young people because there was an article in the Financial Times that talked about be careful buying the dip. Yeah. It could blow you up, especially in the real bear market. So I don't know if there's a new, but just because something's working today doesn't mean it's going to work tomorrow. That's all I'm saying. And,
and just because you're making good money right now doesn't mean you're going to be making that tomorrow too.
That's
so
right.
You have to be cautious in what you do. I made a lot of mistakes, lost a lot of money. And I wish I would have had that time and experience back. But as you said before, you gain wisdom the longer you live, and hopefully you can learn from other people's mistakes before you do them yourself. But I feel like that just doesn't happen.
How many times have I made the same mistake? Not on me.
Yeah. Yeah.
It's like stupid.
Yeah. Well, one last thing. I mean, Buffett just took a position in Alphabet for the first time ever. He passed on tech stocks for years and years and years. Didn't invest in Google. Knew about it. What do you think about that? Because that
love Google. Here's what's interesting. You ready? I'm going to throw this one at you, and you're going to look at me like, okay, Dom, how do you do that with a derivative structure? The clients I have in Google, I'm getting from their buying price. They're getting 150% of the upside, and they're capturing only 50% of the downside. You can't do that with buying the stock. So that means if Google is up 30, I'm up 45. But if Google's down 30, I'm down 15. What a great way. I love Google. Why? Because think about it. They were the originators of AI. I mean, you could go down Google and you could type in a sentence and it would give. Now they got Gemini.
Yeah.
3.1, I guess.
Yeah.
And yes, it's ChatGPT 5.1, but how could you not be long Google? So let's be long Google in a very smart way. And I 100%, I own Google, but I own Google through a derivatives business. I haven't bought a stock in 10 years. I could always get a better value by using a derivative structure. Now, I'm not saying, hopefully these kids are not, oh, just buy calls or buy a put. No, it's more complicated than that. But the bottom line is, spend some time and really, really understand how derivatives work. And that's what I do. And that's why the kids will work for me for free, because by the end of my semester, they know more about derivatives than 90%. The reason why DU and CU asked me to do an adjunct, because the PhDs didn't understand it. So they reached out to somebody that was an expert and said, can you teach this stuff?
Yeah.
I said, yeah, I do it for a living. I do it every day. So
is there anywhere online people can find more of your work or
investps.com?
Okay.
I have a TikTok, investps.com, a lot of stuff in there.
Okay.
It's just the concept of risk management and the concept of hedging within a portfolio framework. It shouldn't be so outside the box. It really shouldn't. But the Citadels are doing it. The firms that are running their own money are doing it. And I want to say one last thing. I get a call from a friend. He says to me, Dom, what do you think about this? It's this much money. It's $18,000 to buy into this, and they guarantee you 10, 20% a month. And I said to him, let me ask you a question. If they were making that much money, why would they have to sell it? I don't have to say any more than that. If they're making 20% a month, why wouldn't you just use your own money and keep it a secret? Why would you sell it?
Yeah, they would just be borrowing money.
Yeah. Borrow money at 3 or 4 and make 20, or 30.
Yeah.
So,
well, like I said before, a lot of people can't do math. That's why, people still play the lottery.
They still do. It's very profitable.
Got to pay to play. Got to play to win.
I don't know.
Dominick, it's been amazing having you here today, and I met a new friend for sure. So thank you for your wisdom. Hopefully this has been beneficial to everybody out there. Please share it. If this has been good for you, make sure you make some comments. Reach out to Dominick if you have other questions, and it's good. I mean, whenever we talk about finances, people tend to glaze over, but we went through it a few different times so that people hopefully can get the concepts a little bit easier and not have to be PhDs. But, money is what runs this world, right? I mean, it's, and ultimately it's time. And if you have money, then you have more time to spend with your kids and what you want to do,
Yeah.
So,
and I would say, like all of us, whether it's a doctor, whether it's an attorney, whether it's an advisor, try to find somebody that really cares. It's really about, my dad always told me, put it up or shut up, just be quiet and be the best you can be. I'm not sure what a professional is anymore. To be honest with you, I thought a professional was an expert, but whether it's a guy I hire for my house to fix something, or I go to an attorney and, is everybody just chasing money? And it's how about those people that really care and really want to do the best for you? They're hard to find. When you find them, hold on.
Yeah. Preserve that.
Yeah.
Well, until next time, we'll see you another episode of Regenerative Inspiration. And again, thank you, Dominick, and we'll see you then.